Okay, thanks for that, Chandan. Wishing you a good Friday ahead as well. Appreciate you joining in and giving us your thoughts. Well, let's move on. Syrma SGS Technology, they posted a solid set of numbers. The revenues were higher. Growth was seen as well across segments. The order book, well, that looks good as well at around 1,700 crores. But the company in the conference call, well, they said that demand from European market is subdued due to macro headwinds. To understand how the second half of the year is going to shape up, we're joined by Mr. Sandeep Tandon, the executive chairman of the company. Good morning, Sandeep. Thanks so much for joining in. Well, you had a blockbuster listing, so now the numbers are going to be very, very crucial. First half of the year has done pretty well. There are some challenges, as you said. You've done around 850 crores odd. Normally, the second half of the year is better, right? So what kind of a number can you end at for this year? I think you were talking about 1,700 crores odd. Can you better that number? And margins have improved as well. Do they get to around that 12% odd mark? What's the steady state?
So I mean, I don't want to give any forward-looking statements. I can only give macro statements that are there in the industry, right? We are seeing tremendous tailwinds from support from all our customers and new customers also in the last 18 months. We've seen a lot of interest in India as a second source to China for most of the MNCs. And I mean, we've been in this industry for long years, and we were, the first pioneers to have made electronics out of India for the US markets for customers like IBM, Compaq, Dell. So I have seen this cycle, and never have I seen the kind of interest India is gathering. So now the support from India plus our experience is creating a lot of RFQs and interest moving forward. I mean, this business is not a quarter-on-quarter business. You have to look at it a little more long-term, maybe 5 years. This is a nation-type building business. And we're seeing a lot of interest, which I've never seen in my past, right? So I like to say this is like the Y2K moment of our IT services business. So this for the manufacturing business, the whole perfect storm has happened to push our numbers up. Quarter on quarter, of course, there are a lot of challenges with supply chain still very, very erratic. Even if we get orders, getting the materials in time to be able to service those orders is still a challenge. Of course, it's getting better, but we continue to, lead from our strategy of being very focused on being a partner with our customers, where we can, add more value, design as well as manufacture for the customer. So theoretically, our margins are higher, but when you're growing, right? When you're growing, you don't have the same yields as a steady state situation.
Got that.
So that's yeah.
Yes, I mean, it's great to hear that, this is a Y2K moment and you're seeing a lot of potential. In fact, you do have a lot of competitive advantage, right? I mean, you have large customers like HUL, TVS, you have very strong wallet share across companies as well. And I was going through the trajectory of your margins. In the last 5 years, your margins have gone up from, I think, 6% way back in FY17. And now you're almost a double digit. In Q2, you did about 10%. Do you see more scope to improve your gross margins? A, because input material prices have corrected, but there's also, there's operating leverage, there is your growth in the ODM business, and the benefits of the PLI scheme. How much do you think, I'm not asking for numbers, but is there a big margin headroom for you?
So there is a mix, right? When you're growing, you can't expect to make the same kind of margin at steady state. So I love to say yes. I mean, our teams are all activated to drive superior margin. And when you grow, of course, you get the scale benefits. Those are definitely there. But when you're growing with new product assemblies, and you don't get, like, for instance, last 6 months, right? We put up 2 new plants. I mean, the revenue from those plants is minuscule, but the full staffing has been done. So once we start seeing stability as we grow, but the growth is still very real, we will start seeing definite margin improvement. But I don't want to give markets elated numbers and say this is totally doable. We have to continue to strive. It's a tough business to
Yes.
it's a services business, so we have to work very, very hard.
The big chunk for you, Sandeep, hi, good morning, is printed circuit board assembly, right?
Right, that's the biggest
it's almost 80% of your business.
Absolutely.
And is that, I mean, are there any challenges at all, or more and more of this stuff is getting outsourced? I mean, is it, we are hearing from companies in the US, for example, a lot of talk of onshoring. I mean, do everything in-house, right?
Yeah. So definitely that's a trend, right? They want to be as global. This China scare has really shaken up everybody, right? And the lot of interest is to be near shore or onshore or a different supply chain. So these are ways we also win in a way, right? So it's not one large factory that you're competing with in China that has completely owned the thing. So you actually can add, when you do nearshoring, PCBA actually gets made by us and the final assembly is done in the US near the customer. So it actually adds more value for us. So that's not a competitive negative, it's a positive.
Now, how does it add value, Sandeep? I mean, the best would be if you manufacture here and export, right? But if you have
correct, so no, we manufacture. That's what I'm saying. So PCBA is a input material for the final assembly. For instance, we have a customer in Germany who makes industrial washers, right? So we make the PCBAs.
Right.
They do the assembly with the mechanical parts in Germany.
Okay, all right. Sandeep, getting back to some numbers, as you said, it's a Y2K moment, and you've added some capacity, right? At peak, I think you can do what, 3,500 to 4,000 crores, taking into account this, this capacity that you've added. Are we getting that correct?
At peak, that's correct.
3,500 to 4,000 crores, right? So let's not talk near term then. When do you get to this number? If things are looking so good, Sandeep, we need a couple of numbers from you. Near term, we're not.
I've been advised that I cannot give numbers. So yes, it is totally possible within the next 2 to 3 years.
So by FY25, you will be, in that vicinity of around 3,500 to 4,000 crores of revenues. We've got that one. What about for this year? The second half of the year is better. Are you with me on that one? Normally it's better. I'm just looking at your numbers for the last few years.
In the past, it has been better. Yes.
So you have done 850 crores in the first half. The second half of the year will be a little bit better, going by your order book, going by business.
Correct.
So we're working in the vicinity of more than 1,700 crores at least for this year.
Yes.
And margins will get better as well from here?
Yeah, they should. I mean, they should get better. Yeah.
Manage a couple of numbers.
I don't know what.
I know it is hard. I mean, I understand that it's not easy.
I've been told, my lawyers have been told, don't say anything. I'm like, no.
We're just
trying to get a sense from you. We're just trying to get a sense from you on which way things are headed. This ODM business.
This is my first time out, so
sure,
please bear with me.
Sure. This ODM business, I just wanted to understand. In the last four years, your compounded growth rate has been a bit slow. I mean, it's been in low single digits, about 3 to 5% for ODM particularly, right? Now there is this PLI scheme that will perhaps give you an edge against your international peers. On steady state, can you get to double-digit compounded growth purely for ODM? And what is the kind of capex that you plan to put on board? I think the last number I have is about 150 crores that you've done in the last between FY22 to FY27. I think that was what you had outlined. Would you look to change that in any way?
So we'll probably in the second half also we'll manage to do about the same capex this year. We are locating we are in the process of finalizing a new facility also, so that as soon as that is there, the capex will go in. And your previous question was on ODM, right? So ODM growth is dependent on approval of the products, and it takes a longer time. So the cycle of a ODM is a lot longer. And what I told you, right? Since this is a Y2K moment, there's a lot of existing stuff that is coming to us that, hey, we are building this X factory, we want to move. Can you take it? So, I mean, I'm not going to say no to business, right? So when ODM products are what we call new product introduction. So you work with the customer, design the product, get the approval, and then build it. So we are not, when you get 40% growth, you can't manage with everything being equal growth. So our goal is definitely to continue that partnership, build on ODM, but that, it's not the same path, because like I told you, it's the interest is very high right now.
All right, Sandeep, we wish you all the luck. Thank you very much.
Thank you so much.
Great having you with us here, as always. Thanks. Well, Mitesh is with us with a quick check on how the pre-open is shaping.